My name is Raphael Nkomo. I'm the Chief Investment Officer at Taquanta. The subject of the presentation today is about the NGI core income funds. The presentation itself will have two main parts to it. In the first part, I'm going to talk about our views on interest rates and inflation. And then my colleague, Sharika Salie, will take you through the more detail about the fund performance and so on. Just in terms of the interest rate picture, I think we show in this slide, the slide on the left is about we look at inflation in the US. As you can see, the blue charts is core inflation and the orange bars are headline inflation. The chart shows that the transitory part of inflation has come down, as you can see in the orange bars, but the sticky part, core inflation, has not moved since September 2021. So that poses a significant threat to interest rate going forward. If you look at the chart on the right, is interest rate. There has been a significant rise in interest rate over the last year or two, but now we kind of approaching the peak in interest rates. And we're showing on the right-hand chart the Fed fund rates and the 2-year U.S. Treasury. What we note on this graph is that inflation is not coming down as if you consider core inflation, although headline inflation has been coming down, and as such, we don't think that interest rate will come down as fast as the market is expecting. Now, in the next chart, what I do show is a bit busy, but I show 4 different ways to look at the pictures. The first chart, top left, is money supply in the U.S., and we can see that there has been a huge deceleration in money supply over the last year or two. On the bottom chart on the left is about the Fed balance sheet. You can also see that the Federal Reserve Bank in the U.S. has been unwinding its balance sheet at a fairly rapid pace. So if you look at it, the top right charts, what we showed there is the lending standards in the U.S. All the senior officers at the banks are reporting that they're tightening the lending standards. But then at the same time, on the bottom charts on the right, you see the market is expecting a steep cut in interest rates sometime later in the year. So this, to us, is a bit unsure at this point in time. We think that inflation is likely to be sticky, and if inflation is sticky, we don't think that interest rate will come down as quick as the market is expecting, and that has implication, of course, for interest rate in South Africa. Just before we show the South Africa picture, we want to show how the macro picture is evolving in the US. The blue line is our estimate of the leading economic indicators, and then we overlay that with US GDP. As you can see, there's always kind of a tight correlation between the leading economic indicator and GDP, and that the current state of the leading economic indicator is that the US is probably going to go into a recession sometime next year. In terms of the picture in South Africa, I think the picture in South Africa looks pretty much similar to what we saw in the US. The blue bars are headline inflation. The orange bars are core inflation. As you can see, core inflation has not moved. And in fact, if you look at the trend, it seems that core inflation is actually coming down. Core inflation is actually going up while headline inflation is coming down. Now, our estimate on inflation going forward is what we show on the chart on the right, is that inflation will come down towards the band, the 3 to 6 band, and then it's likely to stay there until 2025. So in terms of interest rate implications, the FRAs, we show the FRAs at different points, but the most relevant one is the bottom line, which shows that the FRAs are now pricing that interest rate in South Africa is unlikely to rise, and in fact, that interest rate will come down sometime around 9 months from here. Now, we believe that all of this thing put together, inflation in South Africa is likely to be sticky, like in the US. We think that interest rate is likely to be sticky in the US and in South Africa. And as such, the move by the Reserve Bank that we saw last week is not an indication that the Reserve Bank is ready to cut interest rate. As far as we're concerned, we think that interest rate at its very base will stay at these elevated levels for some time. Now, I think the problem that South Africa as a country we have is that interest rate is very elevated everywhere in the world. So we show in this chart real interest rates in many countries, and I think where you have to focus is the Latin American countries, which are very similar to South Africa. As you can see, real yields are very high, anywhere between 3, 6, and 10% if you consider Mexico, Chile, and Brazil. That poses a challenge for South Africa because our real yield, even at this current interest rate, is still sitting around 3%. So we're not really giving a significant advantage in terms of real expectations. Now, just to sum it up, we have a final chart which shows where to from an inflation point of view from these levels. We show what is happening in South Africa and we show what is happening in the US. We believe that in South Africa, there's still going to be a big drop in inflation next month when the July number gets reported, and that will probably bring inflation in South Africa to around 4.5%, which will be the bottom of inflation. Now, going forward, if you look at the subsequent numbers on the month-on-month print, in August last year, it was 0.2. In September last year, it was 0.1, and so on and so forth. And those numbers are easy to beat. So if we get to about 4.5 in inflation, we think that this is likely to be the bottom in inflation, at least in the short term, and that inflation is likely to drift slightly upward from those levels. And will that provide comfort to the Reserve Bank in South Africa to cut interest rate? We probably think not. They're probably going to maintain interest rate at this elevated level for some time. If you look at the picture in the US, we think that inflation is bottom in the US around 3%. If you look at the month-on-month reported inflation for July last year in the US was 0. In September was 0.2. And then you had a couple of 0.4, 0.5, and 0.2. So this also indicates that inflation has probably bottomed in the US, and that from this level, inflation will rise moderately going into next year. Again, if inflation starts to rise and core inflation remains sticky, and then the US economy, it remains very strong and printing 200 to 250,000 jobs a month, it's not an environment where the Federal Reserve Bank will rush to cut interest rate. And as such, our view is that inflation, yes, has come down, but mostly headline inflation. Core inflation remains sticky, and that's the key determinant to cutting interest rate will be about the strength of the U.S. economy. As we see right now, there are very little sign that the U.S. economy is weak, but like we showed earlier, there are definite signs that there is a recession, and then we're pricing in a recession sometime next year. If that is the case, a recession will resolve all of the inflation problem, and eventually interest rate will come down. So for now, until we get there, we think if you have the Nedgroup co-investment, co-income fund is generating about 10% return, will generate about 10% return in the next 12 months or so. These are extremely very high return for a very low and very liquid investment portfolio. We think cash in between will remain king. We do believe that an overweight position in cash is fully deserved in this kind of environment. This is really what I wanted to talk about very quickly in terms of interest rate and inflation. I think my colleague Sharika Salie will take over from here, and then she will go into the portfolio details of how the fund is currently positioned. Thank you.
Good day. My name is Sharika Salie, and I'm a portfolio manager at Taquanta Asset Managers, managing the Nedgroup Investments Core Income Fund. I'm going to be going through how the fund is positioned, as well as how the fund has performed. This slide shows some of the attributes of the fund. The Nedgroup Investments Core Income Fund is the largest short-duration fixed income unit trust in South Africa, standing at 51 billion rand in size as at the end of June 2023. This is a low-risk fund that offers investors 24-hour liquidity and benchmark-beating returns. The core attributes of the fund are safety and stability, liquidity, low volatility, and adherence to CISCA regulation, as well as Regulation 28 of the Pension Fund Act. The high client retention in this fund is due to the consistent performance of the fund, as well as the above attributes highlighted in this slide. The team has been around for quite a long time. The longest standing team member that has been managing this fund has managed it for 18 years, and the second longest standing team member has been managing the fund for 15 years. Size is a huge benefit when it comes to the money market and short duration fixed income space. It allows us to get better yields from issuers, and it also allows us to manage liquidity more efficiently. Okay, so this particular slide, it shows what I've done here is I've put 3 different types of funds with different sizes. So on the left, we have a 50 billion rand fund. In the middle, we have a 20 billion rand fund. And on the right, we have a fund size that has a size of 10 billion. So this is just trying to show what large inflows does to a particular fund. Okay, so if you look in the middle row on the left-hand side, this will be more like the core income fund that's about 51 billion in size. If we were to get a 4 billion rand late inflow, we'd have to put that money on call, and the yield on the fund would go down by 8 basis points. If this were a 20 billion rand fund, the effect of such an inflow on the yield would be a negative 18 bp in the performance. And if the fund was smaller on the right-hand side, a 10 billion rand fund, the effect of a 4 billion rand inflow into such a fund would reduce the yield on that fund by 31 basis points. So this illustrates that we have the ability to absorb flows with minimal yield impact. Over here, this shows our guiding principles, and this has been our philosophy at Taquanta for the last 25 years. Our priority on the cash side is to preserve your capital and offer you liquidity while earning you an income at very low risk. Taquanta has been managing cash mandates for over 25 years, and we have a simple and proven track record. Capital preservation is the cornerstone of everything we do, and the fund is very conservative in its investment approach. We believe we add alpha through term premium and the extraction of the liquidity risk premium. The liquidity risk premium is simply the additional value demanded by investors where any given security cannot be easily sold or liquidated into cash for its fair market value. We source high-quality assets, so with our large purchasing power of 190 billion, that's Taquanta's AUM on the cash side alone, we are able to source high-quality assets at attractive spreads. In the fixed income market, unlike equities, it is very much a volume game. The bigger your deal size, the better your rate. We have a bias towards floating rate instruments. Floating rate assets immunizes the fund against interest rate risk, and the underlying instruments held in the fund moves in line with moves in the repo rate. We manage spread risk in the fund. We do this by evaluating term premium and ensuring there is a healthy spread buffer in our portfolios. And lastly, we manage liquidity risk. We only invest in high quality investment grade issuers, and the type of instruments we buy are liquid and tradable. Our internal market of 190 billion is a huge advantage to our clients. So for example, if a bank were to issue a 1-year NCD today at JIBAR plus 60 basis points, they would buy that asset back at JIBAR plus 80 basis points. So instead of selling the asset back to the bank, we would sell it in our internal market at JIBAR plus 70 basis points, where the seller gets a 10 basis points benefit and the buyer gets a 10 basis points benefit. On average, we have about 4 to 10 billion of maturities every month. So whenever we experience outflows, we do have natural buyers for the assets that need to be liquidated. So the fund has outperformed the benchmark despite a challenging local economic environment. The purpose of the slide is to illustrate the consistent performance of the fund against its benchmark, STEFI Composite Index, and the low volatility of returns. At the end of June 2023, at that MPC meeting, the SARB marked a pause in its tightening cycle after 10 consecutive rate hikes. Since November 2021, the SARB has hiked interest rates by 475 basis points, and the repo rate stands at a 14-year high of 8.25%. This bodes well for funds with low duration, such as cash funds, in particular this fund that we're looking at now. The minimum outperformance gap of the Nedgroup Investments Core Income Fund tends to be slightly north of 1%, and we have consistently generated this outperformance since inception, and most importantly, across various interest rate cycles. This over here shows the big 4 bank wholesale NCD issue spreads. So this is just talking to show, this is the numbers that talks to the buying power that I was speaking about earlier. So if you look at the table on the right-hand side, you will see NCD issue spreads that's quoted on Bloomberg and Reuters. Those spreads are for deal sizes of 500 million and less. Next to that, we have what's called wholesale or bespoke issue spreads from the big 4 banks. Now that spreads is for a deal size of minimum 1 billion. So you can see just by our size, we are generating 10 to 15 basis points extra than a smaller manager. If you look at the chart on the left-hand side, you can see bank wholesale NCD spreads are more attractive than the long-term fair values, and that's why we have been significant buyers of NCDs at these levels, especially where you see the spikes. So term premium is also wider than pre-COVID levels, so the above bodes well for reinvestment in this portfolio. So whenever there's maturities, we know we can reinvest that maturities at spreads that are better than their long-term fair values. This over here shows the counterparty exposure in the portfolio. The fund prefers businesses with stable annuity-type revenue streams, and we tend to avoid cyclical businesses. As of June 2023, 77% of the fund is invested in the big 5 banks, and the rest is allocated to investment-grade foreign banks, South African government instruments, money market unit trusts, and AAA-rated SPVs. The fund has refrained from corporate and credit investments due to the mispricing caused by an influx of cash into short-duration income funds, leading to price distortion. There are currently only 42 non-bank bond issuers in this market, and together they hold around 170 billion in listed debt. Now let's put that into perspective. When we compare it to the 459 billion issued by banks and the 3.3 trillion of government-issued debt, we can see that the corporate credit market is relatively small in size. So increased demand in this market can significantly impact security prices, resulting in lower credit risk premiums driven by higher primary issuer demand exceeding company targets. So understanding the dynamic of the South African listed credit market is crucial for us making informed investment decisions and managing credit risks effectively. This over here shows the credit rating breakdown of the portfolio. So the conservative credit selection continues to support returns in the fund, and the high credit quality profile reduces the risk of default, which is key to the protection of capital. The fund is also externally rated by GCR, and it has obtained a favorable investment grade rating of AA. This chart shows the issuer breakdown, and I just want to note that the fund is highly liquid. So we would like to shed some light on the various types of debt issued by banks to dispel the misconception that all bank-issued debt is the same. In reality, banks can issue different types of debt with varying tenors, levels of liquidity, and even different levels of capital risk. For instance, bank-issued sub-debt such as AT1 is a loss-absorbing instrument, and banks can call on this asset during times of stress. So even though it has a very high yield, it carries both liquidity and capital risk, not to mention the volatility this asset adds into a fund. However, in the Nedgroup Investments Core Income Fund, we only invest in senior ranking debt, and we steer clear of any subordinated debt instruments. Our preference lies with negotiable certificates of deposits, also NCD instruments, as they offer ease of tradability and they can be converted into cash on the same day in large volumes. This fund offers clients 24-hour liquidity, and as a result, it is crucial for us to manage liquidity effectively, and NCDs issued from the Big Five banks serve as the most liquid and tradable instrument in the market. In contrast, JSE floating rate notes are not as liquid as NCDs because banks are not obliged to make a market in this type of debt. The fact that banks are required to make a market in NCDs makes them our preferred cash instrument, and we hold this significantly in our cash portfolios. Moreover, pricing for NCDs is transparent as banks publish bid and offer spreads daily. It is essential to note that we do not consider deposits liquid instruments, and as such, we demand a liquidity risk premium for them. With a deposit, you can't break a deposit. If you buy a deposit from a bank, you have to wait until that asset matures. You can't trade a deposit between funds. Consequently, you will find that bank deposits are issued at a higher yield compared to NCDs. When it comes to listed credit, we have our reservations in terms of pricing. Most listed credit investors buy their bonds at issue and then they hold them to maturity. So that results in a lack of visibility on the true credit spread market pricing, as there are often long periods where there are no trades in this type of instrument. So to get a grasp of the mark-to-market is quite hard. I am concerned that many investors are not aware of the risk-reward imbalance they are faced with in this market, particularly due to the flood of cash that has flown into short-duration fixed income asset class. So I think the blowout will come if there is a massive outflow from income funds, although I can't see this happening at the moment due to this very high interest rate environment that we are in, but there is definitely liquidity risk. That is why we stick to bank NCDs and to a certain extent FRNs. I need to know that I can sell what I'm holding if things go bad. If you buy one of those instruments that never trades, if anything goes wrong, you will never be able to sell it. A good example was African Bank. By the time African Bank got into trouble, the bonds didn't even sell off because they didn't trade. They just went from not trading to being unlisted. The economic growth prospects for South Africa are currently limited, and the country continues to face challenges in terms of electricity shortages, which pose a significant risk to its economy. However, despite these difficulties, the fund in question is in a favorable position to navigate the current economic climate. We have kept the weighted term to final maturity of this fund low at 2.2 years. So even though the fund can invest out to 7 years, we've kept the weighted term to final maturity at 2.2 because this low weighted term to final maturity protects investors from spread widening, while the relatively low duration immunizes the fund against interest rate risk. So in summary, our approach to debt investment revolves around careful consideration of liquidity, tradability, and the risk levels to ensure the best outcomes for the Nedgroup Investments Core Income Fund. Okay, so this over here is what is called a smarty box. So in 2022, cash was the best performing asset class, and we expect cash to remain king in 2023. Currently, 3-month JIBAR is around 8.5, and the weighted average spread of this particular fund is 120 basis points, which means we expect the fund to yield the end of this quarter, so the end of September, at 9.70% NACM, which equates to an NACA yield of 10.14%. Thank you very much.